Good afternoon, everyone, and thank you for joining us. I'm Danielle Fugazy, a contributing editor with ACG. I will be your host and moderator for the next hour as we talk through one of the most anticipated reports of the new year, Citizens 2025 M&A Outlook Report. I look forward to this every year as it helps everybody kind of get set for the new year. I think everybody on this call probably knows Citizens, but for anyone who doesn't know, Citizens is a rapidly growing commercial and investment bank offering deep expertise and a full suite of coverage from insight through execution. What we're going to go through today is the 14th annual M&A Outlook. And it's so important, like I said, because it helps the deal-making community understand what their peers are thinking about as we head into a new year. And it never disappoints. Just like years previous, there are some very interesting findings in this report. So for today's event, we'll cover a variety of M&A related topics, such as overall economic predictions, thoughts specific to 2025 middle market environment, which factors and considerations will impact activity the most. And then we'll have time for Q&A. As Holly mentioned in the beginning, please chat your questions into the Q&A pane on the Zoom call at the bottom of your console, and we'll get to as many of those as we can at the end of the conversation. You can submit them throughout, and we'll leave a little time at the end, but we do have a lot of information to get through. So first, just to tell everybody who our experts are here today, I'd like to let each of our panelists introduce themselves. So can you guys each just take a minute and introduce yourselves? Why don't we start with you, Andre?
Sure. Hi, everyone. My name is Andre Jeffers. I am the Group Chief Strategy Officer of Anser McAl Limited. Anser McAl is a large conglomerate headquartered in Trinidad and Tobago in the Caribbean, with operations all throughout the Caribbean and in the U.S. Diversified conglomerate, but our major sector influence would be in manufacturing, financial services, and the beverage sector. Great to be here, part of this panel. My sort of experience and expertise is largely in mergers, acquisitions, private equity through stints at Lehman Brothers, Barclays, the Carlyle Group, and then returning home at Anser McAl. Would have recently worked on the opposite side of the table, so to speak, with Dave and the Citizens team on a acquisition of a chlor-alkali company in the US, which was a significant acquisition for us. So happy to be here. Happy with the relationships I've been able to forge at Citizens, and look forward to a good chat today.
Thanks, Andre. I think that you're going to add a really great perspective here. Dave, why don't we move it over to you?
Sure. Thanks, Danielle. Hi, Dave Dunstan. I'm a managing director in the M&A group here at Citizens. As Andre mentioned, had the fortune to work with a company which we sold to Anser McAl and worked directly with Andre, which I enjoyed very much. Glad to have him join us today. I manage our industrial practice, but spend most of my time on specific verticals, complementing my other industrial colleagues. My specific focus more around engineered materials, engineered products, and the manufacturing and distribution of those products. I've been doing M&A for 30 years, so hope to bring some of that context to our conversation today.
Thanks, Dave. And last but certainly not least, Devin, can I turn it over to you for an intro?
Yeah, thanks, Danielle. Hi, everyone. I'm Devin Ryan. I am a managing director in the equity research department here at Citizens. My background is over 20 years in equity research, covering financial services companies and financial technology companies. But really, I think the relevance here is, studying the publicly traded investment banks and alternative asset managers, which I've had a lot of experience with. So I kind of live and breathe the capital markets data, and obviously M&A is a really critical piece of that. And so kind of sit at the intersection of that and talk about that with our institutional clients, and then also spend a lot of time with the senior executives of companies running investment banks and alternative asset managers. So hopefully bring some perspective to the data itself. So looking forward to the conversation again. And that's it. Thanks, Danielle.
Thanks. We're looking forward to the conversation too, and I want to get right into it. But before we do, I just want to make a little announcement because I've already got a question about it. This report is going to be available after today's presentation. Actually, it's going to be downloadable, and we'll show you how to do that at the end of today's webinar. So with that, Dave, I want to let's start with you, and can you actually start by providing us with some context around the report, so the audience has just a little bit of background of, the genesis of the 2025 M&A Outlook report.
Sure, happy to do that. I've been a participant in this presentation and in analyzing both the formation and delivery of this report for a number of years now. I enjoy it because it really gives you a sense of the market's sentiment as we start the year. I think the timing of it is important. I also think, and important to note, that the respondents are highly credible, and that makes the results more impactful and meaningful. So we interview 400 business executives and PE executives of middle market companies, 25 million of revenue to $1 billion of revenue, which is really the core middle market. And we get their feedback on the economy, on M&A dynamics, on specific company matters. And so these individuals, of course, the executives of PE firms, the executives running these businesses, really have their finger on the pulse. I think that gives a lot of credibility into the data and the output that we'll share with you here shortly. You'll also notice throughout in 2025, there is certainly a weight toward positive sentiment, and more positive than we've seen in a number of years. So I think that bodes well for M&A and certainly for broader prospects around the economy and comfort with regard to business performance. So look forward to sharing more of that in the presentation that'll follow.
Thank you, Dave. Okay, so let's go back to our slides here, and let's start with taking a macro look at M&A industry trends. Devin, I want to turn it over to you. You're probably best positioned to provide an overall perspective from an M&A industry on the M&A industry dynamics.
Sure. Thanks, Danielle. So this chart here is really data that I love to look at as an analyst to kind of think about the M&A market. What this is global announced M&A volumes going back over 30 years. So really kind of a long time series. And, it really gives a perspective that, this is a long-term secular growth market. So M&A over the long term grows, but what you also see is kind of that really significant cyclicality of that market as well. And you see that kind of around the trend line. But what you can see is there are patterns to this. And so, the patterns are generally, once you've kind of peaked in activity, it takes 1 to 2 years to kind of reach that bottom. And then it generally takes 1 to 2 years to get back to kind of that trend line. And so I think the point here is that, we're in the cycle, there are patterns, and this cycle is no different. So you had, 2021, which I think we can all remember was kind of a perfect year for the markets. And as you see kind of that data point here, M&A activity was well above the trend line, nearly 50% increase from 2020. So I think we all knew that was probably an aberration. But then what you see is, 2022, 2023, pretty significant decline and well below the trend line. And so, that's the normal cycle. We bottomed, it looks like, in 2023. And then 2024, last year, was a better year. Volumes were up about 13%. So some improvement, but what you can still see is that there's a nice kind of increase to go here just to get back to that trend line. So there's still about 25% upside from the 2024 level just to get back to the normal historical trend line. So, I think that speaks to the point that we are in recovery, but we're still not back to normal. And I think that also really goes well hand in hand with the data of the survey. So looking forward to discussing that, but this is kind of the macro view that we're in a recovery, but we are still far from what I would say is normal. And I think that the data backs that up as well.
Thanks, Devin. Yeah, that's a good point. This really does bode nicely with the rest of the sentiment that the survey showed. So, Dave, let's turn it over to you. The survey actually indicates that sentiment is at a 5-year high, with 54% of respondents indicating that the 2025 M&A environment is going to be strong. So kind of goes, like I said, hand in hand with Devin. Why don't you tell us a little bit about what you think is driving that sentiment?
Yeah, sure. Happy to do that, Danielle. I think over 30 years, I've gotten comfortable thinking about M&A as if it's in the environment, as if it's on a scale. And so there's always positive things and negative things happening broadly in the economy and specifically with individual companies we're working with. What you look for are trends in that scale when it's weighted more to the positive. And I think that's what you're going to see in this conversation today. Certainty is prevailing over uncertainty, confidence over lack of confidence. And that environment, which we'll get into in more detail, the specific elements of that are driving this, allows for a more robust M&A market. And you see that certainly in this sentiment data. You think about from an M&A takeaway standpoint, when business owners, executives, private equity groups, banks, financing when these entities are feeling confident, your ability to negotiate transactions goes up markedly. Forecasting is easier to do. Diligence is easier to do. Valuation, you can get your arms around more confidently. And again, the financing is more readily available. So we're seeing that environment that's leading to some of this sentiment. And then I think too, with regard to the point Devin raised, we've seen a lack of M&A activity now for 3 years, 20-30% below industry norms. There's a pent up supply of companies to be sold and dollars to be invested that are looking for green shoots. And we're seeing it. Certainly we'll highlight those green shoots in more detail on following slides. But all of that, I think, is coalescing around this sort of positive dynamic that we see with regard to sentiment on this slide.
Thanks, Dave. Andre, I want to turn it over to you and just get your perspective on if this is how you feel as a company.
Sure. Yeah, I think it aligns. And, when I first sort of saw the data here, it begs the question on sort of, how does this, level of confidence at 54%, how does that compare to pre-COVID levels? Obviously, given that, 21 through, maybe 23, there was a lot of uncertainty and now marked improvement. And, from my research, I've seen that, from the historical surveys, we are kind of effectively at 54%, sort of in line with the 2019, 2018, 2020 levels. So again, I think the story ties together that, call it, 3 years out of the uncertainties of COVID, there is a level of certainty. And look, to Dave's point, a lot of times, because M&A is sort of a combination of human emotional behavior and then the financials and the strategy, a lot of times the need or the desire or the pent-up demand to do M&A, either on the buy or the sell side, sometimes brings a level of certainty, and so I think there's that element in it as well, where we may not be on as strong ground as we would have been pre-COVID just yet, to Devin's point, but maybe the pent-up demand and the need to get deals done sort of bumps that up a bit into, we're confident already, and we feel confident getting deals done. So interesting dynamics, I think. All things point in M&A moving back into a normalized place.
Yep. You push that confidence, and then everybody starts feeling more confident and more deals are going to get done. That's great. Thank you. So let's move on and dig a little bit deeper into what we're seeing here. So this chart seems to indicate that larger mid-sized companies and private equity firms are aligned in their outlook and willingness to engage in M&A transactions. Mm-hmm. Smaller companies, they seem to be a little bit more cautious here, as you can see from, well, you can see it right there at the bottom. They're a little bit lower than the private equity firms and the large corporates. Andre, I would go back to you and see what you think about this.
Yeah. Yeah, it is startling when you see the numbers, right? I mean, that's a marked difference from where the sponsors and the large corporates are in terms of, seeing an outlook that encourages M&A. Anser McAl, we do about $1 billion USD top line, and net about 15% of that all the way down. And so I would consider a sort of a small medium-sized corporate. And I think there are a lot of factors that kind of lead to the results you see on the chart. I think firstly, smaller corporates are a lot more sensitive to change, or to changing variables or to unfavorable variables than the larger ones are. And so, for instance, it's the smaller companies that would have been probably hit the hardest by COVID. And so their recovery and almost their PTSD is going to be significantly higher. And so their, desire or confidence to go to corporate transactions, which obviously has an element of risk, I think is probably going to take some time to unwind to get back to that pre-COVID level. I think also, and this is particularly true from like an Anser McAl perspective, we have a much greater sensitivity to interest rate when it comes to M&A. And so while we are in what we believe to be a downward trending interest rate environment, we are still not far off the peaks, which at those levels made M&A pretty uncomfortable and unattractive to small corporates at those levels. And so I think if you look at what this looks like a year out, if interest rates go in the direction we expect, I think you may see this coming a bit closer up to 35-40%. And then the final thing, I mean, large corporates, private equity, they have M&A as a sort of programmatic standard part of their strategy toolkit that in some instances is a requirement for them to generate returns. In other instances, a lack of it tends to be seen as a sign of weakness or a potential area of exposure for competitors. Whereas small corporates tend to want to focus on organic growth, kind of regaining their share of market, their margins that they would have lost at COVID, and wanting to make sure that the organic business is steady. So I think there are a lot of reasons why small corporate is a little bit more wanting to dip their toe in the water as it relates to M&A activity. But I would expect to see next year's version of this have them be a lot more closely aligned to the large and corporates and sponsors.
I was thinking almost the same exact thing. I wonder what this is going to look like in a year if everybody expects the if their sentiment about the economy stays the same. How will their likelihood to engage in M&A increase? I suspect you're correct on that. Dave, can you just take us through what you sort of see here?
Yeah, dovetailing on Andre's comments, as an M&A practitioner during these last 3 years where activity overall has been down, where have the positive dynamics existed? It has been more with larger, more sophisticated, high-quality performing assets. In a better M&A, broader M&A market, B-quality transactions can get done. And so generally speaking, the larger companies who've invested a bit more in systems, capabilities, people are a little bit more insulated, to Andre's point, a little less impacted or volatile from ups and downs in interest rates or other matters. We developed over this period, refined what I would call sort of a 9 tier A quality scale, and really looked at companies that fit within certain criteria: market leadership, proprietary products or processes, recurring or predictable revenue streams, strong teams and systems. There's 9 of these criteria. Those that we could check 8 or 9 of those boxes, we felt highly confident could execute a really good deal in this environment despite some of the headwinds. And anybody who didn't, often the recommendation was to put that deal on hold. And many times those were smaller companies that were still building out their teams, still building out their systems, still building out their strategy. Those can be great M&A candidates in a normal environment, but buyers were just taking less risk on uncertainty in a more uncertain environment. So the data, our experience supports this criteria, and certainly Andre's point of view as well.
Devin, anything to add there?
I think great points from Andre and David. Just a couple of quick things I would add. So completely agree with Andre on sponsors. They're in the business of doing transactions. And if you just look at some of the data, sponsor M&A, first off, dry powder is at a record. It's been at a record $3 trillion. Normal relationship is private equity is doing annual M&A that's about 80% of their dry powder. The last 3 years, it's been less than 40%. So what that tells you is that just to get back to kind of normal relationship, financial sponsors would need to effectively double the amount of M&A that they've been doing, and they're in the business of doing that. So we see that recovering and them having a lot of upside from where they've been. So that's one point. The other point is that large corporations tend to drive activity in industry by industry, and so you think about Exxon's acquisition of Pioneer a couple of years ago that really drove all that activity and energy in the Permian Basin with smaller companies, or Disney and Fox getting together and driving kind of the streaming wars and all the smaller kind of activity. So there's definitely a trickle down dynamic as well. So the larger companies are going to feel confident first, they're going to move, and then that's going to create activity down market as well. And we think that will happen again. So I think that makes a lot of sense in terms of how this data looks relative to those points as well.
That's great. Thanks, Devin. Okay, so just moving on, we want to talk a little bit about the factors that are influencing potential deal flow and valuations in 2025. And it looks like there's some positive sentiment. We sort of touched on it in the last slide, brought by economic growth prospects, stabilizing in inflation indicators, which we just talked about, momentum from the U.S. election, and some other things here. I want to turn it back over to you guys and just get your opinion. What do you guys think is driving the optimism? Does this make sense? Dave, why don't we start with you?
Yeah, Danielle, I think it does. And I mentioned this scale. There's always going to be positive and negatives in the broader economy or with a specific company. Ideally, you're in a situation where the positives outweigh the negatives, and that's the environment we're seeing. These are critical positives. Obviously, economic growth, easing inflation, et cetera, regulatory dynamics, Fed policy. These are significant positives with regard to momentum. There are negatives, potential negatives, or areas that one would need to monitor closely. We'll talk about industrials later, the impact of tariffs, for example. So there's always something on the other side of the scale. A couple of things I would highlight of importance around economic growth and easing inflation. We have been in a period of high inflation, and many of our better performing clients have been growing their business, but often by price predominantly. They're getting profitable opportunities through efficiencies, but volume has been hard to come by in a higher inflationary environment. What we have historically in the last few years been seeing is really price-driven growth. We're now in a period of easing inflation, more difficult to get price. The opportunity for economic growth, which respondents are confident in, will require volume-based growth in the next, as we look to 2025. The one M&A takeaway I would highlight around that is if you're thinking of selling or buying, if you're a seller, monitoring price and volume in your business is very important, and being able to articulate how that trended during the inflationary period and how you expect it to trend in the current environment. Are you taking share? Are you introducing new products? Are you growing volume? That would likely be required to demonstrate growth. So having those systems, those capabilities, really important on the buy side or the sell side to track those dynamics to see what's really going on underneath, the revenue and profit, historical and projected results.
Those are great call outs, Dave. Andre, turning to you.
Yeah.
What are your thoughts there?
Yeah, I think, aligned with everything Dave said, something that jumps out to me when I look at the data here is just the tight distribution between these 5 factors. There isn't any, kind of one thing that folks are hanging their hat on. And I think that's a it reads positively to me that there are several foundational factors that all seem to be trending in the right direction, that's driving this optimism. And so I think with that sort of a rising tide, it speaks to confidence. So, confidence is established when both of your feet are on firm foundation. The foundation feels secure. And that usually requires kind of 3 or 4 different points of stability. And I think what this is telling me is that it's not sort of a one-trick pony that folks are betting on, at which point you then have to, you have probably polarizing binary opinions around whether it's good or bad or whether it's happening or not happening. I think when you look at how tight this distribution is or how widespread some of the factors are, I think it bodes well for a gradual sort of safe landing and for M&A going forward. So I thought that to be an interesting observation in terms of there are a lot of reasons for optimism, as opposed to kind of 1 or 2 very dominant ones.
That's great. We hope you're right, Andre. Devin, I'm going to turn it over to you now and get your thoughts on this.
Yeah, I don't have a lot to add other than M&A markets are not one thing. So M&A can happen in all different types of markets. When people are feeling negative or positive, it can be defensive or offensive. But ultimately, the best M&A market is when there is confidence in your business trajectory as a company or as a sponsor. So I think what this shows is that there is building confidence, and ultimately that also correlates with this notion of kind of an improving sentiment around M&A. So the best M&A market where there's the most activity is where people feel really good about their business and want to go on offense. That's where there's going to be the most amount of activity.
Great. Thanks, Devin. All right. I think our next slide people are really going to care about, which is on valuation. Let's talk about this. The data seems to show confidence from respondents, especially the private equity firms. 88% seeing valuation bounce to higher in 2025. So increase in 2025, 88%. Andre, maybe we can start with you. Do you think that this is correct? Do you feel like we got it right, the respondents?
Yeah, I think so. I think it is all tied together with some of the themes that we've been discussing. I think what I take away as being interesting is that there's a significant decrease in the number of respondents that spoke to a decreasing valuation expectation. But a lot of those that went from the expectation of decreased valuations ended up, it appears, in the sort of stable valuation conversation. It wasn't that sort of 180 of movement from a decreasing valuation expectation to an increasing valuation expectation. So, when I look at this, I see cautious optimism in terms of how sponsors are looking at valuation and upside. Some of it may be just managing expectations around what valuations look like and could mean for their business. But it's interesting, there is at least a shift towards there being a more stable or increasing valuation environment, which is sort of normal course of business in the US. And so all ties into a return to stability, a return to deal-making environment.
Perfect. Dave, can I turn it over to you? Get your thoughts here?
I would just go back to Devin's earlier point that the private equity groups have significant dollars to invest and typically a 7 to 10 year cycle to do it. There's been 3 down years in a row, 20-30% down. So there's more dollars that need to be deployed in a shorter window. You also have strategics with more cash and access to cash through their financing partners that have more confidence in their business based on the confidence metrics we noted earlier. That bodes well for deploying capital around growth and M&A. So when you have a lot of dollars chasing, at this point, still fewer deals, pricing, generally basic economic supply and demand should go up. And we do expect that to be the market we're in, at least until such time that the volume starts to catch up with the dollars that are out there.
And Devin?
Yeah, all I would add is really, the M&A market, I think, has been affected by the inability to sell assets. You think about your private equity, where valuations went to in 2022, 2023. We've kind of been on this recovery pace, and so private equity, needs to exit assets to be able to get the gridlock to move on from that. And I think that's going to be a big part of the story. So private equity, to be able to go make investments and use that dry powder, needs to be able to return capital to their LP. So I think this kind of recovery that's already underway and the future outlook for continued recovery and valuations is really important, just to get that engine going again. And we're seeing early signs of it. But I think there's a lot more exits that need to happen to then put more capital to work on the private equity side.
Yeah, that's a great point. I actually went to a outlook at a middle market private equity firm, and they said the mandate they got from their LPs is sell. It's time to sell. So I think you're right on there, Devin. Let's drill down a little bit more on valuations here, so we could talk about it a little bit sector specifically. Devin, I'm going to stick with you. What do you think here? Is financial services right? What do you think?
So, my background's 20 plus years in financial services, talking to institutional investors, but also, I head up our fintech research as well. So kind of technology fits within that. And, I think this is spot on with where we are. And I think some of it is a little bit of a function of where we're coming from. So, financials, you go back a year and a half, incredibly out of favor as interest rates rose rapidly, a lot of regulation. And you had a lot of the institutional investors go from really underweight to, as it became more clear the Fed was going to change its stance on interest rates and begin to normalize on policy, people started to move from kind of underweight to equal weight. And then you had the presidential election, which I think added fuel to the fire with this notion of kind of deregulation. And so I think there's a little bit of definitely a lot more optimism around valuations. Valuations have recovered, but also particularly in financial services, financial service valuations in most pockets are not stretched. And so I think this view that there's still a good ways to go here in a recovery scenario with some of those tailwinds I just mentioned, deregulation is one example. And so this absolutely makes sense. And we're seeing it both in the private markets, but also, some of the most sophisticated institutional investors that we speak with, I think, are also feeling the same way with probably the mix here in these sectors.
Thanks, Devin. Dave, can you give us a little bit about some of the sectors that you cover here?
Sure. On the industrials front, we are expecting, as many are, to have several interesting, exciting tailwinds driving industrial growth, particularly here in the U.S., which is of course important. These growth dynamics, some of which go back to COVID, post-COVID supply chain, et cetera, include things like reshoring and the opportunity to manufacture and have U.S. or nearshore supply chain dynamics. That's going to drive more activity in U.S. industrial manufacturing and distribution. Infrastructure and the need for investment to support some of the other growth dynamics I'll mention in a moment. AI and its impact on data center and the infrastructure required to support that is a very significant growth driver. Related to that, the electrical infrastructure, products, utilities, grid needed to fuel this growth and support these dynamics is significant. Semiconductors, U.S. support and access to significant supply of semiconductors and the investments required for that. And of course, recently, under the new administration, oil and gas and the parts, components, et cetera, associated with it. These are all significant trends, several of which are 5, 7, 10-year kind of growth cycles. That is a great environment to be an investor in these businesses. That drives valuation when there's comfort. It won't be a straight line exactly up and to the right over a 5, 7, 10-year period, but that's certainly the trajectory, much like that first slide on the M&A environment, the U.S. industrial landscape looks very positive, and investors are bullish.
Great. Thanks, Dave. Andre, any insights from any of the sectors that your
Yeah,
your company may invest in?
sure. And I'll be brief. Maybe I'll take one of those in the bottom quartile. Our business, we are the most significant brewer of beer in the Caribbean region, and in a lot of the markets we operate in, we have very significant market share. And then we also have brewing assets in the U.S. as well, in Cape Canaveral, Florida. So we touch a lot of the consumer side of the business. To echo on one of Dave's points, I think the inflationary environment has really curtailed volume growth. And I think, even in our business, a lot of the growth we have seen have been, gradual price increases, and just kind of leaning on the elasticity a bit. But I think until there is more share of wallet at the consumer level to drive volume growth, it's going to be a challenge to get increased valuations in that sector, because obviously, continual price increases aren't seen as sustainable. And so I can understand why consumer ended up sort of bottom quartile. I think it'll take some time and a bit more of that easing before we start seeing sustainable growth, and therefore sustainable valuation growth in that sector.
And that makes sense. So we've touched on the buyers and sellers market a little bit, but let's dig into it a little here. I want to ask you guys to share your thoughts on the increase in the sellers pool this year. It may be those private equity firms that we were talking about, but the sellers actually rose by 10 percentage points over 2024. Dave, why don't we just start with you? What do you think here?
Sure. Well, I mean, first off, the sentiment, all the data we talked about around the positivity, you think about that scale dynamic I was referring to earlier. The scales are weighting, certainly as we kick off this year, in favor of positive dynamics over some of the negative challenges that yet need to be overcome. You also have the supply-demand dynamic we talked about earlier, where there's been 3 years of underrepresented sale activity. And one thing we haven't talked about, but I think important, is demographics. We've got an aging population, of course, a significant number of baby boomers and Gen Xers that are getting to the point where succession planning is important. And we spent 3 years where they were sort of sitting on their hands, not able to execute some of the more meaningful succession planning, like private equity sale transactions, M&A activity. And so the idea that sellers, now that there's green shoots, the opportunity to potentially bring forward some of that activity that should have taken place in a normalized environment, the spike in seller interest, I think, is logical.
Thanks. Devin, what speaks to you here?
Yeah, well, first off, I agree with everything David's just said. So you have the time dynamic of just a couple of years of not really much happening. So you have that pressure and just a normal cycle. And I think that's playing out. The pressure that we talked about from private equity to sell assets. And I think that's playing out. But then also valuations, which we just talked about. Valuations are now in public markets, we're at kind of all-time highs. We're back to the high water mark. So if you're a seller, you probably didn't want to sell, at a, in your mind, a big discount to where you had been trading previously. We've now recovered that, or for the vast majority of companies, recovered that. And so it's just a better time to sell with where market valuations are.
Makes but sense. Andre, I turn it over to you for your thoughts.
Yeah, I'll focus on the buyer line, which is effectively flat over the last, 2-3 years. I see that as sort of upward and downward pressure, which maybe 2023 has a different story than 2025, although they kind of roundabout at the same level. And yeah, it's a combination of pent-up demand to buy, but the downward pressure of the fact that, a lot of stuff is expensive right now. Valuations are up there, and I think 2025, where you see that great delta between seller sentiment and buyer sentiment, it speaks to that. Sellers know that in this market, in and around where valuations are, that they are going to get, a nice premium on fair value if they decide to go to market. Buyers they tend to be cautious of that, and so while there's the upward momentum of stability, confidence, decreasing interest rate, lower borrowing costs, etc. The buyer sentiment has not moved as much as you would think, given all the nuggets of positivity we spoke to previously. And I think a lot of that is due to that, where valuations are and how that could play a part in buyers still being cautiously optimistic.
Thanks, Andre. I just want to remind our listeners here that we're getting to the end of our presentation. So if they do want to ask any questions, now is a good time to go ahead and submit your questions. So this slide, it's kind of interesting to me. After a number of years of declining international deal settlement, perhaps maybe because of COVID, it looks like foreign deal interest is on the rise. And I want to start with Andre because he's kind of global and I think has a unique perspective to talk about this. But Dave, I would also throw it to you too, just to think about the idea. A few slides back, we talked about the idea of reshoring, how this slide kind of reconciles with the idea that companies are looking to reshore. So hold on that, Dave. Think about it. Andre, let's start with you. Can you give a perspective on what you think about international M&A being strong this year?
Sure.
Or the sentiment being strong?
Yeah. So look, I think likelihood to sell is driven by awareness of buying activity. And I actually think it's the likelihood to buy that drives the likelihood to sell. I think for the most part, sellers are typically agnostic if they're in and around the right valuation and they don't have issues with ability to pay and so on. It tend to be agnostic, right? If they can get a deal done. So I think this willingness to sell spike is really driven by the fact that there has been more and more international players participating in processes relating to U.S. assets. And so let me focus a bit more on the likelihood to buy outside of the U.S. And so, there are certain industries where, there are constraints with many of the larger international conglomerates as it relates to finding growth in their domestic markets. Antimacabre is an example of that. We are tapped out in many of our core areas in our region. And I'm sure you would find the same for many of the large sort of family-owned legacy businesses in Latin America. Tapped out in certain instances in order to compete for more growth within our region. We likely can't access that because that's probably owned by a rival family or someone else that wouldn't sell to you, right? That's typically the dynamic in Latin America and the Caribbean. And so you look at, where are the stable markets where I can replicate my business success? And the U.S. represents a stable, a stable market. So just kind of interesting in that the international community is not averse to investing in the U.S.
Thanks for that perspective, Andre. Devin, let's go over to you.
Yeah, what I see here is really just also a sign of the maturation of the M&A markets and really the middle markets as well. So just the notion that companies are becoming more sophisticated and broadening the breadth of the continents that they would think about selling to. And so you essentially have more buyer pools. And then also just the maturation of the private equity markets and just private equity capital setting itself up outside of the United States. And if you're going to raise more capital, you can do that in the U.S., or you can also go into new geographies and start new funds. And so we've seen a lot of that and heard a lot of that from the companies that we cover in the public markets where they've had a big appetite to grow their pools of capital outside the U.S. So I just think there's a sense of just the market's maturing. It's become more global, and that's helpful to a company looking to sell where they have more potential buyers and essentially buyers looking at new markets that maybe they weren't looking at before.
That makes sense. All right, Dave, I'm turning it over to you. And like I said, I'm curious about the reshoring versus more interest in going abroad.
Yeah, that was a great point. I think the dynamic where companies operating outside the U.S. that may be negatively impacted by our reshoring activities would be inclined to pay a premium for U.S. assets to retain some of those business relationships and volume opportunities. So that's an opportunity if you're a U.S. company with strong U.S. operations where an entity outside the U.S. may again pay a higher price to develop access or reestablish potentially opportunity in the U.S. that they might see declining if they continue to ship into the U.S., from whatever country they're based in. So definitely an opportunity there. I think that's where that reshoring is our manufacturing companies try to find sources and capabilities domestically. It's going away from some other outside entity. And so that's a nice way for them to come in and buy something and reestablish that connectivity. Of course, there's CFIUS and other criteria that one has to go through when there's an international buyer. It's a regulatory dynamic that's unique to international acquisitions of U.S. businesses. But I see that as an opportunity for U.S. companies looking for potentially a premium in a sale. And I agree with the other comments that were made here as well.
That's great. Okay. So we are at the point where we are going to start taking some questions from our audience. We've made it real simple for you to go ahead and get the whole report. You just have to go ahead and scan that QR code and you can get the report, or at citizens.com/M&A-Outlook. So feel free to go ahead and download that whole report. And I just want to say one other thing that's really important. There's going to be a survey at the end of this. When we finish, we really ask all the attendees to please take it. It helps inform future surveys and will only make this report better based on your answers. And it's really very short. So with that, let's get to some questions. You guys good with that?
Sure.
Right. First question. How do we look at the political, monetary, and fiscal policy landscape in terms of the impact on 2025 M&A? Anybody?
Well, I think if we go with the surveys, the respondents' perspective was that there's positive dynamics with regard to the election, with regard to Federal Reserve policy, with regard to interest rates and easing inflation. It remains to be seen. This is sort of that scale, and it can shift throughout the course of a 12-month or 90-day period. And you got to monitor these things, of course, throughout the year to see how they play out in reality. But as we enter the year, certainly the 400 people we surveyed would suggest that we're on strong footing in those areas that would be positive relative to M&A activity. We certainly hope that that is the case as well. And again, you have to monitor. Anything can change. Any one of these areas can shift. And so we'll want to keep track of these dynamics throughout the rest of the year.
Yeah, I would just maybe add, I agree with everything David just said. I mean, the biggest voting mechanism right now is the stock market, right? And so we have the election, there's puts and takes, right? And policy and uncertainty. But right now, the stock market and valuations are reflecting a relatively upbeat tone overall. And so I think that is what you need to look at to understand, is the trajectory going to be positive or does something change? And if the stock market valuations were to shift abruptly, or there's some new information that's maybe not getting factored in right now, that would be something that at least I'm watching as potential risk to, I think, this positive sentiment that the survey showed, and also I think what we're talking about here. So that's a big condition. But right now, I think you put it all together, and there's generally a favorable outlook in the market, and I think that's consistent with the survey up until where we are today in the market.
So just kind of staying on that, there was a few questions as I'm just trying to get them together and consolidate them a little bit on the IPO market in general, and if we'll see more IPOs. And while that's not really what we're talking about here, we're talking about private companies. I figured I would just throw it out there and see what you guys' thoughts, if anything, on the resurgence of, the IPO market.
Yeah, I'd be happy to start there because I think we started this conversation on kind of long-term M&A data and kind of these trend lines and the macro view. IPO market is very much the same. So we have the exact same data on kind of a 30, 40 year story, and you have that long-term growth, but the cyclicality around it. And the cycles, they tend to a little bit less so follow the business cycle, but they follow the market cycle. And so, the IPO market, you just look at equity capital markets overall. We said, M&A needs to increase 25% to get back to that trend line. Equity capital raising would need to increase over 50% to get back to trend line. So it gives you the sense that we're even further away from what I would argue is a normal market, and IPOs will play a large role in that. So that's the data. And then the anecdotes are, we talk to a lot of companies in technology and financial technology, and you essentially still have that pent up, that dynamic that exists in M&A where, there's really been very few IPOs over the last few years. A lot of companies that maybe would have hoped to get out in 2020 or 2021 didn't. So now they're looking at this window reopening. And the good news is a lot of these companies have really improved their financial position where they've focused on growth, but also increasingly focused on profitability. So the next wave of IPOs I expect are going to be a really high quality batch of companies that have really understood what the public markets are demanding right now and are going to be better positioned than maybe some of these companies that came public in 2020 and 2021. And it was kind of a growth at all costs and profitability wasn't as front and center.
That's great. Thanks. Okay, so I have a few more questions I really want to get to, so I want to keep moving here. Can you comment, I think this is a good question, can you comment on the potential impact on the M&A market of tariffs on Canada and Mexico and Chinese businesses? Anyone?
I would just say a couple things there. First, will there be tariffs? Will it be trade negotiations? What's the outcome to be? Hard to say. There's a lot of discussion and negotiation that'll take place behind the scenes. And eventually, this is sort of similar to the earlier comment, we're going to want to track and monitor this to see what the impact ultimately is and what the outcome may be. But I think I do know in talking with clients in the industrial space, as well as private equity groups that own businesses in this space and are looking to acquire, it is a question that people want some clarity. In the event of these particular tariffs, what impact would that have on your business, its profitability, its revenue growth, and other opportunities? What alternatives do you have to address these dynamics? These are important questions. So as you think from an M&A context, if you're preparing to sell or buy, these are questions you want to ask and investigate. What's your supply chain look like? What's your end revenue customer mix look like? And could these tariffs, if enacted, how would you manage those? What would the impact be? Nobody knows exactly what's going to happen here, but managing those risks and articulating how you would do it is important as you think about trying to get M&A done in a context where your business may be exposed.
Okay. Dave, I feel like you mentioned this, but anybody's free to answer. There was talk of some challenges in 2025. What are you guys keeping an eye on? We talked about all these positives. Is there anything that people need to be keeping an eye on?
Well, one of the things I was referring to is tariffs, which we just talked about. I think it's an interesting uncertainty that is on the other side of the scale for most companies that needs to be managed and understood and is still unknown. I mentioned something very important around volume. The only way, in my opinion, we get economic growth is we see volume growth. Andre highlighted the consumer and their role in volume growth. That's a bit uncertain. there are some really great in industrials tailwinds, which I think are quite positive. But to achieve some of those things, you need a buyer and a seller, a willing party on both sides. And so tracking volume growth, earnings expectations, you get an opportunity to see that quarterly from the public companies. What are they seeing in terms of both price and volume and their estimates for the remainder of the year? Tracking those, I think, are going to be really important to whether we get to this robust environment we think we're heading into or not. But those are the big things for me. Do we see volume growth? And, in the industrial world, tariffs, what might the impact be on supply chain and revenue opportunities for those that are exposed to them?
Thank you. So with that, I'm going to ask you each for a wrap-up comment, just what, if there's one piece that you think people should take away from this, what that is. But right before they do that, I just want to ask, let's put up the QR code so people just have a chance to download that as we're just talking through our final comments here. So, Andre,
Yeah.
not to put you on the spot, but maybe we can start with you.
Yeah.
What would you say is a key takeaway for people?
I would say a key takeaway, I mean, there are a lot of M&A practitioners on here who sit either potentially on the buy side, the sell side, or right in the middle from an advisory perspective, or maybe from a financing perspective. What I would say is, in whatever role you're playing, take advantage of the fact that particularly when it comes to sponsors, to a lesser extent, large corporates, there is a real pent-up, in some instances, requirement for deals to get done. And whether you position yourself as a buyer in a sponsor process, you position yourself as, potential advisor on the buy or the sell side. I think as long as there aren't any significant headwinds coming our way, I think this is going to be a year where, particularly sponsors are going to want to get deals done, both in terms of putting dry powder to work, and also in terms of coming out of investments they've been holding for 3 or 4, sometimes even 5 years past their typical horizon. And with that deal pressure in the market, there could be some opportunities for arbitrage, for some good pickups, and opportunities to create value in whatever your role is. So I think, notwithstanding us being in a perfect M&A environment, don't be surprised if you see the type of volume and activity that makes it feel like we're in one of those, and how you can position yourself to win in that instance.
Thank you, Andre. I'm going to turn it over to Devin, but before I ask you for your final comments, let's just flash our disclaimer so while Devin's talking, we get some housekeeping out of the way. Devin, what would you say is key takeaway here?
Thanks, Danielle. So I think my key takeaway is that we're in a cycle, and there's normal cycle conditions that are playing out here, and so we are in the early stages of recovery. I think the data suggests that. The survey results really go with that. And so, the cycle is kind of playing out as we would have kind of mapped it out a couple of years ago. So I think this is normal. And then, completely agree with Andre's points on sponsors that sponsors have been absent from the market, and keep an eye there because they're such a critical piece of this M&A market overall. And my earlier point, sponsors could more than double their level of activity and just get back to normal. So this concept of where are we with sponsors, there's a huge amount of activity to come here and just to get back to kind of your more normal historical trends.
Perfect. And Dave, last but not least?
I'm just going to, I think they covered the key takeaways. My recommendation to anyone thinking about M&A in this environment is the key to success is often preparation, building the team internally and externally. Not everyone is fortunate to have Andre on their team. Many companies don't have that internal M&A expertise, but find it, build it, and leverage your external, the lawyers, the accountants, the M&A advisors. Preparation is the key to success, having discipline, knowing what you want to buy, knowing what you want to accomplish in a sale, having access to the right data. These kind of things are the key to really executing buy-side or sell-side transactions. So invest in the preparation. It'll pay off in the long run.
On behalf of ACG, Dave, Devin, Andre, I just want to thank you so much for sharing your insights. I think our community really looks forward to this every year. You have a million questions waiting for you to answer offline. So I think that's a testament to how much everybody really appreciates this survey and your insights. So with that, I thank everybody for joining us. Have a great day. And don't forget to download the report. See you all soon. Thanks.
Thanks, everyone.
Oh, and take the survey. Thank you.